Yeah, it's starting to record. So it's more of a valuation model building, and it is not really a session to scrutinize the financial model or to look at how to view the financial model, because that's a different agenda altogether. This is more of a scrutinization of not scrutinize. This is more of a objective valuation model building exercise. Now, the last time where we had stopped is to arrive at the free cash flows of the firm, and that is where we could truly look into. After that, everything got sped up. So I'll just give a quick brief. So now to arrive at the free cash flow, we have linked the EBIT, earnings before interest and tax, directly from the projected cash flow. This is typically a template that I follow in my practice. So in this EBIT, the EBIT is linked to the P&L. Now, what is this EBIT consisting of? It consists of depreciation, of course, EBITDA, and after EBITDA, depreciation, other income, and other expenses. Now, there was a contentious debate at the Manthan group, at the Manthan session, at whether this particular other income should form part of free cash flow to the firm. And there were various arguments that were put forth by various people. So one of the core arguments that were put for the fact that it should not be considered is that it is you are already considering cash and cash equivalents when you arrive at the equity value. Why do you need to consider the return on such cash and cash equivalent again? So that is one of the core arguments put forth. And few other things were one of the experts told that you need to consider the other income, but the other income has a different risk factor as against the general operations. So the other income has to be discounted at a different discount rate. And that is in fact put forth by Chinmay. And one other, so ultimately some of the people consented that it should be part of the free cash flow to the firm, and some of them told that it should not be. So post the Manthan thing, I had the opportunity to go through some of the texts which are out there, some of the research studies, like for example, how does NACVA consider this? How do Shannon Pratt and all of that consider this? So there is no definitive definition anywhere. So in any of the texts, it doesn't define that free cash flow is either operational or it should include non-operational. So when I applied my mind across all of these things, the conclusion that I came to is, from a valuer's perspective, ultimately, it's all about risk management. Is the other income substantially adding to the valuation of the firm, or it is not? So that is something primarily first we need to consider. Secondly, we need to look at the historical financials of the company and check whether the company has a continuous history of investing its cash and cash equivalents in, let us say, mutual funds or fixed deposits, and the other income forms part of the operations regularly. It is not only done for the purpose of projections, but it is done on a regular basis. So if it is done on a regular basis, I have, in my opinion, and in my decision, that in my practice, I will adopt other income as part of free cash flow to the firm. But if I see that the other income has only come out of only in the projections years, and it may not be significantly done in the history. It is a new thing that in the projections that they have done to manage the free cash flows, to manage the cash and cash equivalents better. And in such a situation, I will be taking a decision to exclude that from the free cash flow to the firm. So this is my little study post the Manthan session that we had. So that was one of the contentious issue, and you may note down this fact if you want to discuss further. I will dedicate about 20 minutes or 25-30 minutes at the end At that time, we can have a discussion on this matter, the other income part. Then the rest of the stuff are pretty much linked to the balance sheet and the cash flows. Then we have the free cash flows. Then we started discussing about the weighted average cost of capital and how to arrive at it. And we logically began with the computation of cost of equity. So when it comes to the cost of equity, there were various discussions, especially starting from the risk-free rate. So the risk-free rate, it's the general convention that many valuers are adopting. The 10-year Government of India bond or a 10-year that has recently come up even in the valuers group that I've been seeing, that there's a discussion on involving zero coupon bonds for the 10-year yield. So my contention is not about which instrument to include, because it has been rightly pointed out, just a vanilla government of bond yield will have a reinvestment risk attached to it, while a zero coupon bond may not have a reinvestment risk attached to it. So when I deeply look into it, for me personally, it is not about the type of instrument. It is important to include a zero coupon bond because, as it has been rightly pointed out, but rather my contention is about why 10 years. So it has, without a debate, we have been accepting 10-year Government of India bond yield as a risk-free rate. Nowhere it has told you have to use 10 years. Neither does Ashwath Damodaran say you have to use 10 years. So why 10 years? So that is when I studied a little bit, I understood it has the tenure of the bond yield should match up with the tenure of the return on market rate that you have been considering. So I have been considering the Nifty 50 from its listing date, that is 3rd November 1995 was when it got listed at a base index of 1000. And currently it is at, not currently, as on the valuation date of this particular case study, which was 31st March 2022, the Nifty was trading at 17,465, which is basically a 26.5-year period. So what I did when I read through Shannon Pratt's textbook and Grabowski's Shannon Pratt and Grabowski's textbook, I understood that the risk-free rate should correspond to the market return that we have been taking, the age of the market return. So 26.5-year yield Government of India bond yield is what I ultimately took, which is about 7.3%. I drew this number from the FIMDA and FBIL website. FBIL comes out with a publication every day as to what is the Government of India bond yield. So from there, I drew this number. Let me see if I can just quickly showcase to you the FBIL website. You're able to see the full screen or only the Excel sheet?
Only the Excel sheet.
Okay, just a moment. So this is the FBIL website. And here, if you just go to the fbil.org.in, go to fixed income securities. And here, you can just go to the valuation date that you're looking for. Let us say March 2022. So you can just give a couple of days of data and you will get these two publications, 31st March 2022, 30th March. So when you click on this, an Excel sheet gets downloaded. And okay, let me just show you how that Excel sheet will look. So yeah, so this is the Excel sheet that you will get. So I usually go for the par yield. And here, for every tenure that you're looking for, you'll get an annualized return risk-free rate. So when I look at the current, which is about 26.5 years, is what I should be looking for. So 26.5 is the closest one. So 7.34% is the risk-free rate I have adopted. So because it's a 26.5-year-old bond. So that is the one that has been adopted here. Okay. Now, risk-free rate is, of course, the difference between market return and risk-free rate, equity risk premium. How has market return been derived? As I had told you, I have considered Nifty 50 returns from 1995, which gives a return on investment of about 12.56 minus 1.3. About 11.43% is the return on investment just on the index movement. And then there is a dividend yield of 1.13% on the index, which has been realized. So this number, again, you can get it from the Nifty dividend yield, historical dividend yield website. Page. You can get Nifty historical dividend yield in the Nifty website only. So that is the number that has been adopted. I have taken the dividend yield as on the valuation date, which is about 1.13%. So that gives us a total market return of about 12.56%. Again, there were a couple of discussions. One expert on the panelist, Chinmay, had suggested that they consider the Sensex returns for about 30 years. And what they do is they compute the annual returns from every year. Of every year returns they compute, and then they take an average of annual returns. So what it does is it smoothens out any extreme volatile periods like the recession of the 2008 or of the recent COVID that affected the markets. So their approach effectively smoothens out. So that is also a good approach, which merits a discussion. So that is a very simple methodology. It sounds complicated, but it's quite simple. Let us say you take Sensex from 92. 92 to 93, what is the annual return? You put it up. 93 to 94, what is the annual return? 94 to 95. So like that, every year, what is the annual return you put across each side? And every year's annual return, you calculate a average or a median of it. A median number is the best. So a median would be adopted as the market return, and the dividend yield may be added upon that. However, if you're using the adjusted closing balance methodology, you need not add the dividend yield. This adjusted closing numbers are usually available on Yahoo Finance historical data. So enterprise risk premium has been arrived at. Now, whatever ERP that I usually arrive at using this methodology, I try to corroborate my work by reference to other publications. So our ERP is 5.22%, KPMG's ERP is 6%, Ashwath Damodaran's ERP is 5.36%, and Deloitte's ERP is 6%. Ours is on the lower side at 5.22%. Now, the few things to keep in mind in relation to their ERP versus our ERP, why there might be a change, is one is we might have adopted a higher risk-free rate, which is around 7.3%, which considers a longer tenure. They might have adopted a lower tenure and a lower risk-free rate. The valuation date also changes. Ours is computed on 31st March 2022. I'm not sure what time periods they have used and what the dates as on which these ERPs hold good. So these are general publications done for the whole year. These publications are very helpful if you are let us say an analyst where the accuracy does not matter, but the context matters. But for us as valuers, I feel the accuracy matters a lot. So that's why I have computed my own number, which takes exactly to the date and not applicable for one full financial year or anything per se. So, right. So this is the ERP computation. Then we have the beta computation. So the one of the ways to find beta is to, of course, arrive at comparables. Now, how have these comparables been taken? It has been taken from capital IQ, basically. So there are various benchmarks that you can use um, to arrive at. Like you can benchmark it and filter it by industry. You can filter it by the sector in which your company operates in, and you can use various filters like that, and ultimately you can put a filter of listed comparables. Rather, unlisted has to be removed out and only listed has to remain. So you will get a few companies. You can subjectively scrutinize these 5 or 6 companies that you may get. Like for example, how did I do a subjective scrutiny is, I filtered based on all the softwares, all the services companies, not software companies, services companies. And after I filtered based on services companies, I understood there were certain services companies that were mainly involved in product related services and not consulting services. So product related services has a different dynamic altogether as against consulting services. So I removed product related services altogether, and I was only left with 2 or 3 comparables, which I have taken over here. So all of these 4 companies are pure play consulting companies. Um, in our case study, it is a non-profit consulting, which is a specialization. So all of these companies also have a separate specialization. Like Dhruv Consultancy is specialized only in consulting work for the construction industry. Then Explio or Sasken, Explio, I think, is only involved in consulting work for banking and financial institutions. So all of these companies have separate uh, specializations, just like our subject company. And considering these companies, we have done a detailed beta computation. So as I had told in our physical session also, I am very against using the beta that is directly available on websites and picking it up like any of the famous websites. I believe in computing beta based on actual reality and movement of prices and returns. So again, over here, you have to be careful. I have considered this data from Yahoo Finance historical data, which has the adjusted closing price. So all of these price movements are adjusted closing prices. Now, why is adjusted closing price important? If dividend has been declared by the company, the adjusted closing price will have the dividend factored into it. If there is a stock split done or a bonus issue done, the adjusted closing price would be adjusted for those factors. But if you simply consider a plain closing value, all of these adjustments wouldn't have been done, and the number that you get will be very skewed and incorrect. Um, and I consider weekly returns for my beta computation as against daily returns. Why? Because if studies have shown that if you consider daily returns, because of the changes in the market and the market volatility and the stock volatility, most of the times your beta will be closer to 1. But if you consider a weekly return, the real change can be seen over a shorter period of time, and that change would truly reflect the volatile nature of the stock and its changes to the market changes. So that is why weekly return has been considered, and for what tenure it has been considered. So I usually consider for 5 years, where it can be actually told it's a long-term beta. But if the company itself has not been listed for 5 years, the longest period of time, but it should be listed for at least 1.5 to 2 years. If it is not even listed for 1.5 to 2 years, then it's not a good comparable to take for your company as well as for the computation of beta. Uh, so how to compute beta? There are a couple of formulae that you can use. Uh, there is also an analytical tool that you can use, but that is not really needed unless you need very specific data points. That analytical tool is a Excel add-on. But if you just want to compute beta and not look at the regression analysis at various percentiles, deciles, and all of that, you can just use this formula called slope. So the slope formula gives us the beta. It basically arrives at the regression between the market returns and the returns of your comparable company. That is one. And if you are old school and if you want to check whether what Excel has done properly, the statistical formula that we would have all learned is the covariance between the two instruments divided by the variance of the subject instrument. So here the covariance between the market and the comparable company has been computed in the first part of the formula. The second part of the formula considers the variance of the market returns. So this will also give us a beta. This is basically the textbook formula for arriving at beta. And consider the debt equity ratios of these companies as on the valuation date. And from there on, we can see these betas are taken as on valuation date. So again, be careful that let us say you're valuing the company as on 31st March 2022, but you're already in September 2022. Do not consider this stock price movement till September 2022, but limit it only to March 2022. The hindsight the hindsight data does not qualify here to be used. The hindsight information must be used only in a few places. And it's very important, if we are using such hindsight information, we have to mention it in the report very clearly. Even though the valuation is on 31st March, we are using this particular hindsight information because it materially affects the valuation. But otherwise, hindsight information must be limited as much as possible. 99% it must be limited. So consider the levered beta. Whatever beta we get from there is levered beta. Use the debt equity ratio, unlever it. Then we have to actually look for the effective tax rate that these companies are facing based on the profitability that they have. Like for example, Dhruv Consultancy's profit is less than 10 crores. So the surcharge level was a little different. So that is why a tax rate of 33.38% has been adopted. And Explio, Sasken and Saxoft had more than 10 crores of profit after tax. So for them, the effective tax rate will be higher. So the unlevering of the beta is done, and the median beta that we got is about 0.77. And after relevering it for the debt equity ratio that our subject company is facing, I am getting a relevered beta of 0.99. So a few other discussions that we had was, if you are unable to get comparable companies, can I adopt a beta of 1? So I would dead against not recommend that approach at all. Whatever happens, at some way or the other, we need to find comparables. It can be either comparable based on the nature of the company. Like, is it a human intensive company, or is it a scalable company in terms of is it like a SaaS product? Is it a product company or manufacturing company? If it's a very unique situation, we still need to analyze the P&L statement and the balance sheet attributes and see whether the similar attributes are being checked. Just a moment, I'll just put my laptop on charge.
Friends, I hope whoever has attending now got all the Excel files pertaining to this case study. There are 3 files, one case study PDF, one case study in Excel, and market data. Just in case you haven't received, put it on the chat. Go ahead.
Right. So whatever it is, we always need to get the beta from a comparable company, or ultimately you can go by the industry beta. But blindly applying a beta of 1 is not the right approach. It will not hold up scrutiny. If someone scrutinizes our report, we really do not have a basis on which we are standing on. So whatever we do, we should always have a strong basis. The basis that we use may be subject to interpretation, subject to debates and all of that, but a strong basis must always be there. So beta is you arrived at. Um, Now, with this, the systematic risk gets captured. Unsystematic risk is yet to be captured in our discussions. So unsystematic risk is broadly divided between CSRP and small company premium. So for small company premium, I have, as I have mentioned in our earlier Butler-Pinkerton method of discussions, last session I had told that I use this Inquart Capital India Premium Study. So I have linked it here. And the CSRP has been arrived at using the Butler-Pinkerton model. Now, how the Butler-Pinkerton model has been used is based on our comparable company. We have considered a basket of various risk factors that consulting companies face, and based on these risk factors, we have rated each of them based on where they stand. Now, how do we get these risk data? Like, for example, if I have to look at someone like a Sasken or a Saxoft, how do I get to know what is the risk that they face, right? So there are two basic places that you can get risk factors for your valuation. And I'm talking from as practical standpoint as possible. One is if the company has debt, our life becomes very easy because every year they have to get a credit rating, and the credit rating is published. It's usually published if it's a listed company. So you will get the report of the credit rater, and you can go through the various risk factors that they have considered. Like what is the situation with their order book? What is their situation with customer concentration? How is their scale of operations? All of that. And you can use those risk factors to see where your company stands. That is option. That is one. Second is, see, most of the annual reports in India are yet to get matured. So when I look at the annual reports of like let us say a US company, there they have a specific place where they have to discuss about the various risks that this subject company is facing. So it is very easy to apply a model like Butler-Pinkerton in abroad because you get a revised and a fresh perspective of the various risks the comparable companies facing by studying their annual reports. But over in India, when we look at the annual reports in deep, there is only mention of the fact that risk management has been done. Okay, there has been a mention of the fact the auditors give a confirmation that the company has effective risk management system. Neither the directors nor the independent directors, including them, or the auditor ever dwells on the risk factors in the annual reports. But still some of the very well-framed annual reports have a mention of 2 or 3 risk factors, but they're not very open about it. Because I think the market is also yet to mature. And if the company itself admits a particular risk, I think the market may not view those risks in a very kind way. So leaving that apart, the third annual reports is the second one. And the third source is by looking at the prospectus of the company that got listed. If your company is like more than 5-6 years old, this is where you will find the problem. But if it's a company that got listed, let us say within the previous 5 years, the risk factors mentioned in the prospectus of the company would still be relevant, or it will be close to relevant. So you can look at the prospectus of the company when it got listed, and as per a mandatory disclosures in prospectus, the risk factors have to be discussed by the merchant banker who is floating the offer for sale in the primary market. So in the prospectus is a good place to understand these risk factors. So you can compile all of these risk factors, then you need to look at the risk factors that your subject company is facing. And if the data on our own subject company is not available, um, I mean, like for example, let us say there is a bespoke unique risk that our subject company is facing that none of our comparable companies are facing. You can just still list it down and give it the highest risk, and you can find a bespoke corresponding risk which is not available with your subject company, but the comparable company that you have taken up, if they have a risk that is not necessarily portrayed over here, we need to check whether the intensity of risk that the comparable company is facing and our subject company is facing uh, in terms of quantity or quantification of the risk is the same. And if it is the same, then you can bring in that and bring in this. Do not give any rating for our subject company for the bespoke risk that the comparable company is having, but give a risk for the bespoke risk that our company is having, but don't give a rating to them. So then the model, the Butler Pinkerton model will sort of even out, because there will be two highest risk. One which is in terms of quantification is similar, but it may not be similar in terms of other companies. So that way your ratings will match up. You will have the same number of ratings. So once the ratings match up, as we can see over here, I have two of the four comparable companies have been eliminated because the risk profile is not the same. But other two, Explio and Sasken, have been considered because it is similar to our subject company. When we do that, ultimately we get a range of CSRPs. Our CSRP can lie either between that of a Sasken or Explio, which is our computations over here. And based on that, we can come to a conclusion. Our risk-free rate lies midway between Sasken and Explio's risk-free. So midway is a good approach to take, but if you feel like our is on the riskier side, you can take a more riskier adoption of the CSRP. But this ultimately gives us a good material to justify the CSRP in our reports rather than taking a single fudge factor into our computation. So small company premium and CSRP has been considered, and an alpha of 9.49% has been arrived at, thereby leading to a cost of equity of 22.01%. Now, this is the cost of equity side. Then we have the cost of debt. This cost of debt was, of course, provided in the case study. But more than anything, the unique thing that I follow in my computations, which I may be wrong, but it is subject to everyone's opinion, is that when there is a movement in debt, like as you can see from the subject year FY22 ending, there was a 2.15 crore of debt, and it becomes 1.04 crore, then it reduces to 21 lakh, then 9 lakh, 91,000, and effectively it becomes a debt-free company at some point. I try to capture the varied, during the explicit forecast period, the varied movements of the debt. If I consider it as a debt-free company today only, in my weighted average cost of capital, it does not reflect the benefit of having a debt for 4, 5, or half of the explicit period here, right? There is a benefit attached with debt also, that is your funds, the cost of funds is lesser. And at the same time, if I consider the capital structure as of today, it unduly extends the benefit of debt over a longer period of time, because debt has a lower rate, and as you can see, the cost of equity is about 22%. So how I go about it is to compute a weighted average cost of capital for every year. Every year there's a different weighted average cost of capital. As you can see from the subject year FY23, 19.73 has been there. and then 21.45, and then when it actually becomes debt free, it becomes at 22.01%, which is our cost of equity. So this has been considered. The weighted average cost keeps varying every year based on the capital structure of the company, and it has been discounted that way for the time period that has been in use, right? So weighted average cost, right? So the weighted average cost is linked over there, and it has been computed over the time period. Now the convention, again, another convention that I follow is I adopt the mid-year discounting rather than the full year discounting. That is because cash flows do not all come up only in the last day of the financial year, right? So if it only comes in the last day of the financial year, it makes sense to use the full-fledged discounting factor. But it comes throughout the year. The sales and the receipts happen throughout the year. So that is why a mid-year discounting factor has been used over here. So here it has been, time period has been mentioned as 1, but in the formula when I have taken, I have just reduced the time period by 0.5. So this gives a time effective discounting factor of 1.09, and like this, it has been done throughout the life of the throughout the explicit forecast period. Now, since we are using the mid-year discounting convention, right, it doesn't make sense to use the same factor for the terminal valuation. And terminal value, we will have a very detailed deliberation. Before we go to terminal value, I will give a 2-minute window for quick discussions on whatever has happened till now. But the discounting factor that has been used for the terminal period is not the same as mid-year discounting, because when you're using the terminal period, it doesn't make sense to use a mid-year, because a terminal year is all about using the Gordon model ultimately. It has got nothing to do with the timing of cash flow. Terminal value is terminal value, and there will be cash flows coming today till infinity, perpetuity. So there was a flaw in using the mid-year period, and when I referred the Shannon Pratt book, that is when it became clear, okay, you can use the mid-year period for the explicit forecast period, mid-year convention, but for terminal period, you have to annualize the discounting factor and take the annual discounting factor. So with this, I will give about 5-minute window of discussion before we go to terminal value. So there are some questions in the chat box. Okay, let me go all the way back. Okay, case studies have been posted. Before case studies, okay, nothing yet. Okay, slope method, can you explain again? Thanks. Okay, so the slope method is basically, it's a formula. It computes the slope, the difference in slope between the returns. Like if you imagine a graph, the returns that you plot across of the market returns and the returns that you plot across of your comparable company, if you put it in a graph, there's a slope attached to it. What is the slope? What is the, you can say, the difference between the market return and the company return in terms of graphical representation? That is slope. It's a most rudimentary way of putting it across, but you can use this particular formula called slope to arrive at it, and you can get the beta. Then Harish sir has the one showing on the screen. Can you share? Okay, so the file will be shared as soon as the session is done. Management discussion and analysis in annual. Okay, so Shilpa ma'am, it is bespoke, BESPOKE. So when I say bespoke, it means unique, like unique to the company. That is what bespoke means. It is not a generally applicable thing. It is uniquely applicable to the thing. So if your subject company has a risk that is bespoke, like in our subject company, Subbaraidu sir earlier in our session had told, it's a non-profit entity. I mean, it's a profit entity serving non-profit. So if there is an overhang that at some point it will get bad reputation and bad PR because it is making profit out of non-profits. So that is a bespoke risk. Hare Krishnan sir is asking, in some of the models which I have seen, NWC is considered only, networking capital is considered only receivable and inventories in current asset and only payables in current liability. They do not consider the other current asset or other current liability. What is your view? So again, here a good reading of the financial model is important. If you see, there are things coming up in the financial model which are not there in the historicals, right? For example, net working capital, I feel, is one of the most important components in DCF model, because if your financial model has a negative net working capital, it will increase the valuation of the company by a large extent, because it is giving reward for, let us say, you are having a better receivable period, you have done very good negotiation with your vendors, so your receivable credit period is only 10 days and your payable credit period is 30 days, and for you cash is king and you're sitting on cash. Those kind of situations merit a higher valuation. But you need to look at and inspect every item of current asset and current liability, and how it is contributing to the free cash flow. If it is actually meriting it more, if it is giving it a better push into the valuation, but in reality such a strategic asset does not exist, or such a net working capital benefit does not exist for the company, you can go ahead and ask the management either to revise the financial model, or you can consider it in your scenario analysis and change around the working capital ratio that you feel merit the correct usage. So there is no set model like that, as I told you. So there is no considering only trade receivables and trade payables. That a very stringent approach to that would defeat the usage of our own experiences and our own scrutiny of the model. So what about beta computation, as it also depends on capital structure? So Mr. Agastya, I would need a better deliberation on this. Yes, beta is dependent on capital structure. So that is why it has been relevered later on. While arriving at yearly discount factor, the market return, risk-free return beta remains constant. The change is on account of only debt repayment. Yes, only the change in capital structure has been considered for weighted average cost of capital. The risk-free rate, market return, and beta have all been considered whatever is existing as on valuation date. Can you please explain discounting of 5.99 for terminal value? Yes, I will take it up in some time again. Should risk-free rate be adjusted for default risk of country? I don't think so. Once you adopt a risk-free rate, which is marketly available, adjusting it for anything else wouldn't be right, because the default risk would have already been factored in by the market. And that is the whole reason why a rate is established in the first place. Of course, Government of India does not have sovereign bonds. If sovereign bonds were there, our risk-free rate would have been determined by the whole world, by the globe, by the global investors. But ours are only domestic bonds, so it may be limited to only domestic investors and foreign institutional investors, but yet that is still a good enough to be adopted. It does not require us to further adjust any other. Yeah. So actually, Kaushik sir has rightly explained on why the full year discounting has been adopted as against mid-year. So he also has a query, I think, in case of a debt structure of the company is for a limited period, say initial 2-3 years, and the same is funded by the promoters and is interest-free debt, where company do not pay any interest for weighted average cost. How do we consider the cost of debt as zero or market rate? So actually, this is a little bit of a contentious issue. Um, so personally, what I do in my valuations is if related parties and promoters have parked, let us say loan from director is parked in the non uh, non-current liabilities, I consider it as part of equity structure only. And for my debt equity ratio, I do not consider it as debt. Because when they have invested money, it doesn't make any sense for them not to expect any return. So all of that investment is actually very closely tied in with their equity investment. Maybe because of compliance issue or the cost of putting it in a equity, like our Companies Act requires us to pay a certain amount of stamp duty and all of that. They wouldn't have actually parked it as equity. If it was very easy to get shares for whatever money we have invested, they would have probably gotten equity shares for it rather than continue to keep it as a debt, an interest-free debt. So that is why I usually consider it as component of equity. So I may, if I am wrong, please correct me on that particular matter. But I feel it does not merit giving it a 0% interest and giving that extra benefit in our valuation in terms of reducing the discounting rate. Mr. Agastya, you may please unmute yourself and ask. Anyone can generally unmute.
Ganesh here. Ganesh here. This is Ganesh here.
Ganesh sir. Hi sir.
Very good morning. Excellent session. Quickly, two observations and wanted to know more. Since you said WACC, you consider year on year, and which is absolutely correct. But you also said that you do the beta calculations. Beta, if the debt structure changes, your beta also changes year on year. Because the moment you're doing unlevering and levering it, you are applying the debt to equity structure. So do you calculate beta year on year again? That's number one. And second thing is about the GSEC security. 10 years is considered because it is the most liquid security that we have at all for a risk-free rate. If you try to match
most
that,
traded. Okay.
That's why it's liquidity, right?
Right.
Other securities are actually not liquid at all. If you take 20 years just because you want to match the tenor, you might actually end up inducing liquidity risk in the risk rate. So that no longer becomes a risk-free.
Right.
Your observations, please.
So I think that is a point of correction that I need to adopt now because I had not thought deeply about that matter where I need to relever my beta. But that is actually the right way to do. In fact, I will adopt it. Thank you for pointing it out, sir. So that's actually a very good point. So for anyone that could not catch on to that point, it is basically this. I have been considering beta in this particular computation as on the valuation date, like beta computation, right over here. So the beta has been computed at 0.99, which is based on the existing debt structure of the company. While I have been smartly been using the weighted average cost and then this particular beta every year, that is not right. So as Ganesh sir has rightly pointed out, it is better to revise the beta every year and consider the revised cost of equity based on the debt structure of the company that is moving. That I totally understand and merit that discussion. Now coming to the other one, which is conventionally the 10-year Government of India bond has been adopted because it is considered to be most usually traded, like most traded Government of India security. I will have to revisit this particular thought process, it being the most traded uh, maturity of Government of India bond, because I mean, I need to establish it by data points. It may be right, but I have not seen the objective data of it. I was always under the impression that majority of Government of India bonds are traded in the banking sector rather than on the retail sector. And in the banking sector, it is mainly used for the purpose of SLR compliance. And when it comes to SLR, for them, it does not matter what is the maturity of the bonds that they are procuring. And that is proven by their usage of their futures in the Government of India bond futures. And the bond futures by itself, the definition, it doesn't describe that the maturity of the bonds that need to be delivered. It just delivers the quantity of bonds that are needed, and an adjusting factor is later on brought about to adjust for the difference in yields and the returns and the prices of the securities. So that being said, I will definitely relook into it, sir, whether the various bond yields have different liquidities and do they represent the returns that are being set up over here. So I will look into that. And another thing that I have also observed is the bond yield curve. And the bond yield curve seems to be a normal bond yield curve. If there was a wrong risk-free rate established because of, let us say, lack of liquidity, our bond yield curves wouldn't have been the normal bond yield curve that India is experiencing. So these two factors, without looking at the numbers objectively and this particular dimension, I had adopted this. But that is a good point again to merit. I will definitely revisit it. And if I come across a different observation, I will share it in the BBA. Right. I will, let me just go back to the chat box again.
Anjan, continue with your session. We will again take it in the end. Because we already have 1 hour more, that's all, as per plan.
Yeah. So finally, that Kaushik sir, I think it's on the contrary, it has an impact on Companies Act provision as well, to ensure that the promoters to fund out company out of, if they have own funds, they might not have gone for funding. Kaushik sir, if you can unmute and just tell the point.
No, I was just trying to bring out the anomaly that in the Companies Act, when the funding comes across or when they fund it to the company, they should give a declaration stating that it is out of their own funds and not from a borrowed funds.
Correct.
So ideally, if they would have had a own funds and they would not have gone for funding, so this will have a contrary that it has to be paid for the, like you said, ideally the intention is to earn some money and they should have some intention of earning some interest or earning out of it. So I was bringing out that context. That's it. There's nothing.
Correct. Did you also intend to tell that, like, for example, let us say they have done the non-compliance of borrowing from somewhere else and investing in the company?
That could be the risk factor also, stating that if it is out of own funds declared, and that is also a possibility of, yes, that could be a wrong declaration.
Right.
And for income tax, it's very easy to find out that it was a borrowed fund. Just they have to see the same month bank transactions. That's it. Anyway, everything is linked to your PAN.
Correct.
For them, it's the easiest thing, but now they are not going ahead in any of investigation. No, they normally don't look into, personal in bank statement of promoter. They have not.
They're relying on declaration.
They are relying on the declaration, and more so whenever inspection comes to, this is not their forte. They will not usually go into that.
So here in the session, when we were discussing in a separate group, Rajeshwar Rao was having a point. So his point of view was that in any case, when we have this kind of borrowings that we presume to be funded by the promoters, it is ideal to take the interest rate and pay the interest, and also consider the interest rate that for the WACC. That was his point of view. So that is more ideal.
What interest rate would that be? At what rate should it be adopted?
He was of the view that we take the general bank rate kind of thing, or loan rate that is available in the banking sector. If we would have availed the loan from the bank, what would have been the rate or the opportunity cost of rate?
Correct.
Mr. Kaushik,
Yes, sir.
Yes, sir.
I think what Anjan Babu is saying, the assumptions are pretty correct. Compliance requirements of Company Act is only to ensure that is it in a borrowed funds or own funds, but for taking a returns, here we are taking, is it considered by the cost of borrowing or cost of equity? I think considering cost of equity as a promoter, as a part of equity, will be better idea. The Company Act only says that whether is it own funds or is a borrowed funds. Own funds means you can give it as a low interest or you can take a risk. So that I think both are independent.
Right. Yeah. Thank you, sir. So let me now continue with the discussion. We had stopped at terminal value, and I hope Mr. Sagar Shah has got the confirmation why it is 5.99%. It's because we have used the Gordon model, and the Gordon model does not require us to use the mid-year convention, but a full year convention. But up until FY31, the cash flows will be coming here and there. So the mid-year convention is used, but for the terminal period, it may not necessarily be used because the Gordon model requires us to adopt the full discounting factor. So now coming to our terminal valuation. So terminal value, as you can see, I have used two particular methodologies. One methodology is popularly established, which is the perpetuity on a straight line basis. Other model is called the H model. There's also H model is a two-tier model, and it can be done for a three-tier model also. In the in both BVR resources, business valuation resources book updates, as well as in Shannon Pratt's book, there is mention of both two-tier and three-tier methodologies. In our particular example, I have used a two-tier methodology, but three-tier can also be established based on the kind of case that you are facing. So terminal value, again here, one of my gray areas of learning. In fact, if any of the experts on the panel can correct me, I would be much obliged. I am using a growth rate of about 4%. Now, I have done multiple studies and multiple research, and I could not really get a strong study which provides me a very good understanding of growth rate. So the few places that I have checked are, for example, I checked the OECD's GDP projections. And when I look at the GDP projections, the current India's GDP is about 3.2 or 3.3 trillion US dollars. And by 31st December 2060, India's GDP is projected to reach about $45 trillion as per OECD's estimation. And when I consider that, and this is real GDP, this is not nominal GDP. When I consider the real GDP growth rate, it arrives to about 5.22% as the growth rate. So that is one. And when I look at the historical GDP growth rate, let us say from 19 to
Kusum, can you mute yourself? Also, I asked the host to make me co-host.
Yeah. So when I look at the growth rate from 1951 to 2022, the growth rate of India is about 5.5%. So, but both these numbers are giving me about 5 to 5.5% as the range of growth rates. I don't know, but I am not convinced by that number. And I'm unable to get any good publication that tells me otherwise also. but I am adopting a growth rate of 4% in my computations. Please do correct me if I'm wrong, if there are any other good publications on this matter. So Rajeshwar sir is talking about using an inflation rate as on valuation date as growth rate for terminal value. Okay, sir. As on the valuation date. So okay, so that is also can be a good thing, but would it account as a long-term growth rate is my question. In fact, what the experts in the US do is they consider the real growth rate of the company, of the economy, as the growth rate consideration. So I will park the growth rate discussion for a moment. Please do populate your thoughts on the chat box. I will move forward for the interest of time, from the interest of time. So now the H model is basically that why this particular model has been developed is, let us say you get the projected financials only for a period of 5 years or 6 years. And the projected financials, what they do is there is an abrupt growth in the revenues of the company or in the growth of the company. And the model is not built to the extent that it doesn't mature to a long-term growth rate. Let us say about a nominal 5%, 6%. It never comes. The model, let us say, ends off at about 15%, 10% or 20% growth rates. And 99% of the financial models that I have seen in my own practice is all of these models end up like that only. They never bring it down to a nominal growth rate of 4 to 5%, which can be sustainable over a long period. So in our subject company, the growth rate continues to be at around 20%, as you can see, till FY31. So with that limitation being there, there cannot be a situation when 20% FY31 and suddenly it comes to 4 or 5% in FY32, FY33 onwards. So there is a need for maintaining the uniformity of the growth rates, because there cannot be an abrupt come from 20% to 4% in the very next year. So that is why the concept of a H model was actually brought about. In this, what happens is we can define what is the high growth rate phase and for how many more years it will continue, and then long-term growth rate phase, when will it kick in for perpetuity. So over here, the high growth rate phase, which was about 20% continuously, like since FY31, the same rate has been adopted, but you can consider a lower rate based on management discussions or your own subjective interpretation. But you should be able to explain and establish why from 20% it is coming down to 15% or like that. So then you need to define for how many more years that high growth rate phase will be there. And finally, when will the company settle in comfortably into the long-term growth rate? So if we consider 5 more years as, let us say, a high growth rate phase, then and after 5 years of explicit forecast period, the long-term nominal growth rate begins. So using that, you can, it's a modified Gordon growth model formula. The subject of this discussion is not to delve into how the formula is derived and how to use it and all of that. Since I'll be sharing this model with you, you can go through the formula, and the H model formula is very well established in the internet and all of that. So this particular methodology has been used, and the terminal value has been arrived at. Present value of terminal value is arrived at based on the full year discounting rate. And finally, the present value, H model present value, has been adopted in our workings. Cash and bank balance has been taken, and as had been in our case study earlier, we have considered a discount on lack of control in the company in which this particular company has further invested non-current assets. The equity shares, only 5% of holding is there. Recent transaction data available was 3,800 in our case study. But either ways, for the interest of all the viewers over here, a DLOC of 15% has been assumed. Why 15%? Why not 20%? Why not some other number? It is quite simple. As I had earlier mentioned in our physical session, there is no any research data that establishes what should be the ideal DLOM and DLOC that needs to be taken. In fact, whenever Shilpa ma'am gives me another opportunity to present with BVA, in fact, even in the Western circles, there are a lot of debates on DLOM and DLOC. Many people use in the Western society, the restricted stock discount rates. That is, what is the valuations between the restricted stocks and the traded stocks. And then there are many people who use but the problem with restricted stock data is that the data as of today does not exist, but all of these data belong to about 30, 40, 50 years ago. And there are no recent studies, neither are instruments like that, nor does the statute permit anymore to have both restricted stocks and fully traded stocks in listed companies in US. So the data to capture that is very difficult. We have to rely on age-old numbers. Second, the methodology people use is the difference between pre-IPO and post-IPO numbers. Now, the difference between pre-IPO and post-IPO may not just be the discount on lack of marketability or discount on lack of control. It can be a various other factors. So using that also is difficult. So even in the Western society, there are a lot of disagreements. And in the Indian circles, though, the studies only have not been done to give us any sort of data. The last available data is, of course, rather than a data point, it is a order of the CCI for us to consider a minimum of 15% of DLOM. And in case the company, in case the investor is a minority holder, to consider a minimum of 15% DLOC as well, over and above the DLOC. So no data point establishing this but if I missed out anything, please put it in the chat box. I will visit it upon our completion of discussions. So that DLOC has been considered. DLOM has been not considered because this 3,800 would have probably been arrived at after the DLOM has been considered. So DLOM has not been considered again because this is the recent transaction value of a share. So the transaction would have happened, probably the DLOM wouldn't have been used because the transaction by itself is happened. Next, debt has been considered at the values of debt that are presently available. Now, this debt can be considered either as a balance sheet item directly, or you can you can go a bit more scientific and use the present value of debt as the value of debt for reduction from the enterprise value. I have observed material differences are not there in terms of adopting either of the approaches.
You have used only long-term borrowing here. Short-term
Yes.
borrowing is considered in cash flows, right?
Yes, that's right. Only long-term borrowing has been used to reduce the debt.
And your long-term borrowing repayments are never considered in your this cash flow, right? Working capital.
Correct. Because we arrived from FCFF, the repayment cash outflows have not been considered for the purpose of discounting.
Long-term borrowing, it comes in enterprise valuation reduction.
Yeah.
Short-term borrowing will come in working capital cash flows.
Correct. Working capital changes in working capital, it will come out.
So, friends, I just want to highlight this key. Many people, especially when it comes to, director's loan or anything, some confusion could be there. Either they will reduce the whole debt here, or, consider, differently. That is why I thought of stressing this point for the benefit of everyone.
Yeah, thank you, ma'am. That's a good point to be looked into. Now, illiquidity discount has been considered at 20% flat. As I had told you, I have no basis for this other than the fact that years ago, CCI, an organization, an institution that does not even exist anymore, told that 15% is minimum. Now, with that telling 15% is minimum, the only thing that gets established is the fact that there is an illiquidity discount, but is the 15% the right number? It cannot be. Kaushik sir, please let me know. You have raised your hand.
The cash and bank balance is considered for FY23. Shouldn't it be the valuation date?
It should be for valuation date. I think it's been wrongly linked. It should be as on valuation.
Yeah, only that much. Thank you.
Yeah, especially, however, in the provisionals, it is there as on the valuation date. That is the best to consider, and to take a management representation letter again to the effect.
Correct. Yeah.
Now I have linked it. So now equity value after illiquidity discount has been considered. Number of equity shares has been considered at 23.55 lakh. So when I go to the cap table, it is important to just study the cap table as given by the company. You can see here there are two things: ESOP pool outstanding and ESOP granted. The outstanding pool is basically the pool that is not yet granted. It has just been approved by the board. We must not consider the dilutive effect of the outstanding ESOP pool. We can, of course, consider the granted ESOPs. We can make a full dilution out of it. If I'm wrong there also, again, you can let me know. In my practice, I generally use full dilution effect of granted ESOP pools, but I do not touch any other outstanding pool which has not yet been granted. Hari Krishnan sir, please, you can unmute.
You have added the investment in the diversity company, the 5% stake. Now, this investments, whenever there's an investment in subsidiary or an associate, that has to be added back, or is it even an investment in long-term investments to be added, other than the associate or?
So this is the investment existing as on the valuation date.
Correct.
Right?
So the investment is this investment number to be added only if it is within the associate or subsidiary company, or even a long-term investment in other companies should be added here.
All long-term investments must be added. Like, for example, let us say land is there.
Yeah.
Land is also a long-term investment. That also has to be added at its fair value if it is held for investment purpose.
Okay, any investment other than your associate subsidiary also to be factored here, any long-term investment, even if it is a mutual fund or
Yes.
any other listed entity, that entity also that amount also to be added to this value, is it?
Yes, yes.
Okay.
It has to, because it is not getting affected anywhere, no? Free cash flow, it does not get affected because it will just remain as a long-term investment. You may get dividend and interest income out of it, but it is not adding to the value of company anywhere in our workings. So it makes sense to bring in the fair value of that also, because that also forms part of the company ultimately. Right? So it's like thinking from the point of view of, if you have to do a net worth method, that is the book value method or market approach, you will consider all those assets, right? So that is why, but it should not form part of the operations of the company.
I know.
Right?
Because it may have been acquired by way of operating income, which is generated through the operations, but it's not part of your operating.
Yeah. If it forms part of your operations, then your FCFF would have captured the revenues coming out of it and the discount thereon. So it should not.
Oh, thank you.
And also, of course, if you have considered other income in your EBIT, right? That time also, I think you should not bring in, because other income discounted would give you the present value of that investment. So if in the other income, the return on that is included, then it should not be added up again, is my opinion.
Okay.
All right. So this is the enterprise valuation ultimately. Now I'll take another 5 minutes for discussion, and then we will go for scenario analysis and sensitivity analysis. So let me start from all the questions. So inflation rate, Ravi Shankar sir, if the borrowings are non-compliant, there is a risk that there may be withdrawn anytime, thus causing a strain on funds, which is additional risk. Correct, sir. I agree. Then we had a discussion on the growth rates. So Ganesh sir, nominal growth rate is preferred. All right. So I don't think there is any strong reference materials or publications I think we can use for growth rates. If it is there, please do share. Sanjay, sir, if for private limited, can we use DLOC, DLOM? Straightforward. I do not know, sir, exactly what you mean by straightforward, but
if you are doing the evaluation of a private limited company, then can we
sir,
use the DLOC and DLOM?
I am unable to hear you. Is it only me or everyone else? It's not, the volume is not there.
Yeah, we can't hear him clearly.
But yes, sir, if investment has been done in a privately held company and you're a minority holder, whether you're privately held or not, the DLOC should be used. If you are using a listed company, the listed trading prices would have already considered the discount on lack of control, because majority of listed companies, the retail traders, I mean the free float shares are usually minority shareholders. But you can check which, before you come to that conclusion, you can check it out. In case of investments in other companies, if there is no recent transaction, then can the investment be considered at face value if it is a minority holding? No, face value can usually not be considered. In fact, this particular discussion we had in the Manthan session only. If I remember correctly, the professional who suggested the various methods is CA Munish Agarwal. So the various methods that we can use are, one is the net book value approach. Second is the earnings capitalization approach. And third one is you can corroborate all your workings with a revenue multiple and an EBITDA multiple approach. But adopting a face value may not be the right way to go about it. For FCFF, we should both exclude long-term and CC limit. So the changes in working capital are reflected, includes the OD balances and all of that. But the but only in reduction from enterprise value, the long-term debt is considered. Value of debt as on valuation date is to be deducted, or future debt also considered. Sir, I am of the opinion that if there is a future debt in the financial model, it is not strictly a pre-money valuation, but a post-money valuation. So if we are doing the post-money valuation, the whole dynamics of things change. So you can correct my understanding if I am wrong, but I strongly feel that in case the financial model has a future debt, that has to be removed away from the model, and only then we have to do it, and only the value of current debt should be reduced from the enterprise value. Ganesh sir, I will need a little bit understanding on this. How was short-term borrowing estimated in projections? So I would think that the any additional net working capital that is there, which will need funding, to that extent, the borrowing would be estimated in the model. Sir, are you saying something? I am unable to hear.
No, I should not disturb your flow. That's why I was waiting. Whenever you're ready, I can speak.
Okay, right. Value of outstanding debt to be considered as on valuation date. Yeah, that is right. What other items added back from enterprise value to equity value? So cash and bank balance, non-current investments, debt. Usually these are the ones that are most famously. It changes from company to company, but most of the time it is non-current investments which are not operational in nature. Debt outstanding, cash and cash equivalents outstanding.
Anjan, suppose if we take FCFE, that also you can just highlight, how different it could be. Just 1-2 minutes.
Sure, I will do that. Sagar Shah, for adding valuation of listed shares, companies owning, which date should be considered for valuation? That is valuation date or report date. Sometimes share price on report date are 20% higher than valuation date. What should be done? So if you feel like the share price has unduly changed only for the valuation date, like let us say because of our own circumstances that we end up with such a difficult situation where on the valuation date, the share price has unduly changed, you can consider using the average value of the shares in the past 10 days from the valuation date. If the allotment is for promoter, then we should not use DLOM. Is it right? Yes, I would think so. Yeah, because the promoter, then if there is especially a transaction between promoters and all of that, I think the DLOM component should not be there, because rather it is, if there is a determined transaction between promoters, it establishes that there are transactions happening between them. So DLOM may not be considered. Correct, Chandrasekhar sir. If there are different opinions on this matter, that can be shared. Can I call on terminal value part as regards nominal growth rate? Sir, I will need a little explanation on this. I didn't understand this particular statement. Ganesh sir.
Should I speak now?
Yes, sir, please.
Yeah, thank you again. Essentially, since you said anyone put your perspective on terminal growth rate, if you see all the projections that you have been doing, both on the numerator side and the denominator side, are on the nominal values, including the interest rate that you are considering. Nothing is on the real growth rates. So how can you say that you will not consider the nominal growth rate for terminal value? That's
yes, sir. You're right, sir. I'll clear that. In case our projections include revenues which are adjusted for inflation, revenue and cost items, and which are nominal in nature, the nominal growth rate has to be used. In our subject example, only real growth has been considered. So that is why only real growth has been considered.
That's one. Second thing is, typically you asked about whether it should be looked at 1950 to 2022. Going past is absolutely a big no-no. That doesn't how a growth of GDP happens. But one of the important aspects which I consider probably is growth rate. If you look at, actually it's nothing but present value of future cash flows. All this is done, it is a geometric progression. They have used the formula of the geometric progression to come to a derived formula, which we are talking to. Otherwise, it's simply a present value of future cash flows for perpetuity. Now, in that scenario, my only take in this is if you were to look at sector-wise growth, so for example, a services sector which contributes 50% and the manufacturing sector which contributes 22% and agriculture something else, the average of this growth is actually our current GDP growth.
Correct.
So if you were to take a GDP growth as a reference point for your terminal value, and if you are in agriculture sector, actually you are actually overvaluing it, and if you are in a services sector, you are undervaluing it. And
Correct.
beyond a point, any which ways, we narrow down to a particular growth rate eventually when it gives you a particular GDP growth rate. So if tomorrow services sector becomes 80% and that determines the GDP growth rate, and therefore that becomes the growth rate of the services sector. So when you are projecting it beyond say 10, 15, 20 years, the value derived from that is not much of a significance because the present value actually makes it very low. So as long as you are able to visualize which sector and use appropriate GDP growth rate for that particular sector in the terminal value, that should take care instead of just saying that I'll take the GDP growth rate. That's my observation.
Right. Got it. But
And last
one argument on that particular point is, see, all of these estimates of growth rates sector wise that we get, these are not necessarily perpetual estimates of growth rate. These are, let us say, fancily you can say about 10 years projection of growth rate, 10 to 15 years, or I am yet to come across studies which go beyond 100 years of growth rate, growth studies and all of that. Now, by assuming something like a sectoral growth rate, sometimes which is, let us say, higher than the growth rate of the economy, let us say this particular sector, IT sector, if we consider a growth rate, let us say if it is established, the headline numbers are established at 10% long-term growth rate, while the economy may not grow at such a high level. In our computation, we are using a perpetuity model, and the perpetuity model would it probably end up making the logic would be like the sector grows beyond the economical size, and that would defeat our concept of perpetuity, because in perpetuity, if something is at 10% and if another thing is at 4%, the 10% would appear as a larger number at let us say at a certain X number of years. So that is the limitation on the thought process I had on using the sectoral growth rates, which may be higher than the economic growth rate.
Actually, absolutely, you are right. So what happens is the sector's current growth rate of next 15 years may actually be tapered down to a lower growth rate, eventually narrowing down to the GDP growth rate. The point is today, for the immediate 10, 15 years, so assuming that it will go at 10%, and thereafter the following 25 years, it's going to be at 5%. You considering at 5% today itself, you are actually undervaluing the company. As long as you are aware of this, absolutely it's fine. One needs to be aware of it, what they are trying to do, and in their caveats and observation that is taken care, it's perfectly fine. But otherwise, if you tend to do directly 5% from today, when you very well know that this particular sector is going to be higher in at least next decade, indirectly you're actually undervaluing the company.
Correct, sir. In fact, I think the H model can come into help over here. We can use the industry growth rate in the high growth phase if it's a high growth company, and then the nominal growth. The
H model only from that perspective, and so that it will be, we rule out all those caveats.
That's right. That's actually a very good approach. Yeah.
And the last part, which I thought, since you said you gave me an opportunity, the short-term debt. Short-term debt, unless you are reasonable, normally I don't consider in my working capital calculation. OD is more of a temporary thing. It's a rotating part. But otherwise, other than the OD, if you are having any short-term borrowings, which is very difficult to determine from a balance sheet, I don't consider in my free cash flows. I subtract it in the debt part of it.
Yes, sir. I agree with you.
It's difficult to determine is actual, because what happens when you're doing the projections year on year, again, then you're supposed to project now the short-term borrowings, which is not something one does it in the calculations.
That's true. They will take a flat sanctioned number as the number for the borrowings. So if an OD limit is, let us say 10 crore, they simply project out 10 crore throughout the financial model without giving any adjustments.
you so much. Thanks for the opportunity.
Thank you, sir. So Harshil sir has his hand raised. You can please unmute him.
Yeah. Hi, this is Harshil here. So
Yes.
one of the questions that I had, we just discussed about considering short-term debt, right? Another question which we have discussed on that promoter stake, right? We don't consider DLOM for the purpose of promoter stake. So I just wanted to understand the logic, because in promoters, the promoter already have a control. Let us assume that they already have a control.
Correct.
And in a private company, what is the logic not to consider DLOM in that case?
So I can only draw from the example that I have worked on. I have actually not worked on promoter stake allocations, and I have not done a detailed study in that. I have had the opportunity to work on a case where there was a share transfer between promoters.
Okay.
So when there was a share transfer between promoters, they just wanted a fair valuation to be done, just so that there are no misunderstandings. Even though it's based on negotiations and between them, they just didn't want any sort of misunderstanding. So they just wanted a fair valuation report to be done. So there, why DLOM was particularly not used is both the promoters are the market for themselves, and they have found each other, and there is a transaction happening between them. So that is why the DLOM was not considered in the situation that I did. And it is a very situation specific thing. But I mean, that was the logic that I had in my mind. But if I am wrong, or if there are any other viewpoints to be shared on this particular matter, experts in the participants can actually share a view on that point. I do not have a straight line answer on should I consider DLOM or should I not consider DLOM when it comes to promoter transactions.
Okay. I have another question here that we just discussed about that in terms of future borrowing, right? We don't consider the future borrowings.
Future borrowings. Okay.
So, yeah. So we should not consider into the rate model, this FCFF model, right?
Correct.
So the question, the logic here is that if you don't consider the message which is coming out, that whatever the funding will be done for expansion purpose or anything in future will be funded through internal accruals, right?
That's right. That's right.
Okay.
Yeah, even and your financial model may ultimately end up with a negative cash balance also in the balance sheet for a couple of years. I find it is okay. I don't think there is a problem with that.
It not be true, Anjan. Sorry, unless I'm hearing otherwise.
Yeah.
Your future projections very well can have debt, but also the repayment of debt is also captured in the future projections. That's the requirement.
But the problem is that management gives us a projection for 5 years, right? The repayments generally starts after 2 years, 3 years for expansion purpose, because this kind of term loans are there. So what happens that the future models or projection does not consider a substantial portion of those repayments.
Yeah, so which is exactly. So what happens is once we know that the total amount did not get repaid at a particular point of time, so every year you're going to do the repayment of the market borrowing cash flows. There's a whatever last year you have enough amount of debt. So that year you subtract the entire amount of debt from that particular cash flow, and that will be the value of that year.
Okay, so I just put it simply. Right? I am standing in year 0. The management is saying that I'll do a fundraising round.
Sir, I'm unable to hear. I think Harshil Patel sir's audio is off. I'm not sure. All right. Ganesh sir, correct me if I'm wrong on this. I do not think the future debt must be considered as well as its repayment, because it becomes a post-money valuation rather than a pre-money one. So because any additional introduction and changes in the structure of the capital, helping them earn further revenues is not necessarily a valuation as of today, is my understanding.
No, you're absolutely right, undoubtedly, because what I could do is I'm saying that I'm going to borrow hugely and show the revenue significantly high, and therefore show significantly positive cash flows and show high pre-value, pre-money value. I'm not even doubting that. The point is that when someone does show that numbers, okay, the valuer has to really look at the feasibility. For example, if I say that I would like to borrow 1,000 crores, but I have a net worth of hardly 10 crores, whether I can borrow that capital, those are the questions. But you cannot stop someone in their projections not to borrow. So these are because that's the reality is they'll borrow, right? So how can you say not there? So those are the elements. But yes, the moment they start borrowing, if it is within the limits, the cost of capital changes, and those are real numbers. How can you deny someone a value which is normally possible in their projections? Finally, we are deriving a value. Are you saying that a company which has done very well, it has got a great brand name, it plans to expand now over the next 5 years, and therefore it wants to borrow both equity and debt to expand, and it has the ability to expand, and the market is available? Are you saying that the cash flows, the pre-money value will not capture the future potential value derived from those expansions?
Yeah, that's also a very good point, sir. Whatever is feasible and reality is there, and it, let us say, debt forms a core part of their business strategy, and it is very much a reality, it can be included. But I'm yet to work out on a financial model and a valuation model where I can harmoniously bring in the both.
Yeah, it's not easy. So since you said, it's only an observation from me, and not that I'm right there, but my observation that what is possible has to be allowed. That's the statement that I have.
Right.
Manthan, can we continue, please?
Yeah.
Because we hardly have 15-20 minutes.
That's okay.
just
We are anyway
finish everything.
coming to the end of the session. There are only two things, which is sensitivity analysis and scenario.
One important point. I think about the deal on which we discussed, I think it is very important. We should not misguide. Any valuations of unlisted companies, DLM has to be considered even between promoters also, because DLM is considered whenever you want to sell, can you sell the next day? Since it's not possible, DLM has to be there, even promoters or non-promoters. So I think that is very clear. Even the transfer of, when I'm buying today, I have to consider DLM, because tomorrow if I want to sell, I don't find the market. That is for DLM. My point is, deal lack of control, promoter who is already having 75%, we are going for preferential allotment. Can we deal can we eliminate? So I think that's not my point.
Yeah, so someone acquiring more interest, no, they do not. So a minority shareholder selling shares to a majority shareholder, DLOC will get applied for the transaction there. A majority shareholder transferring a majority stake, DLOC does not get applied. A majority shareholder transferring a small percentage of his shareholding to a minority, DLOC gets applied. A majority shareholder transferring a small percentage to another majority shareholder, DLOC does not get applied. So I think
1 minute, majority shareholder acquiring further majority already is a 51%. Further,
I don't think DLOC should apply.
Yeah, that's what. Thank you.
Yeah. So, right. Now coming to the scenario analysis. Now, scenario analysis, it can be built using a particular formula called choose. And Kusum ma'am, I see your hand going up. I will just take up your query as soon as I finish my scenario and sensitivity analysis. So this scenario analysis usually helps us to, especially in situations where we feel the projections are a little off and we do not necessarily agree with the projections. Like, for example, if the revenue growth rates have been taken at a very high level, and as I had earlier told, even in the physical session, that we as valuers, all our valuation model must be objectively built, and we should not use any fudge factors or tools, as we call it, to reflect the risk on the cash flow statement in our valuation model. Like, if there is a high growth rate of revenue considered, there is no merit in using a higher CSRP to bring down the valuation. So that is not I think the right approach. Whatever approach has to be used at the cash flow level. Any changes has to be done should be at the cash flow level. At least we should have the judgment whether the cash flows are unrealistically projected or realistically projected. So that being said, the circuit chancery court in Delaware had in fact merited one of the valuers who found that the projections have been done at a very unrealistic way. They used a scenario analysis to ensure the cash flows are done in a more realistic way. However, the valuation report should have a detailed study and description as to why a certain growth rate or a certain metric has to be used this way and not the way the management has used in its projections. So for that, one of the primary things for scenario analysis, now coming to the practical implementation, how to do it. Excel has a very nice tools to do this, right? The best tool is to use the what if analysis for sensitivity analysis, and the formula called choose. This is the formula that I have used called choose for scenario analysis. Now, how does it go is, these are basically the assumptions that has gone into the computation of the P&L. Now, this assumption sheet, in the particular case here, live scenario has to be, it should be linked to the P&L. Only if it is properly linked to the P&L, actually this is the one, management submission. Yeah, so one of these has to be properly linked. This particular case, live scenario, was actually linked before I did the scenario analysis. If you look at the case study in that sheet, you can see all of this is properly linked to the P&L. Now, whatever is there, first is we need to determine what are the areas for which we are going to conduct a scenario analysis on. Is it the revenue? Is it the salary? Or is it a direct cost component? Is it a revenue? Is it an indirect cost component? We need to determine which one we are going to do and what are the rates that we are going to take. So the three different scenarios that I have chosen only for the purpose of this, it has not much thought has gone into it. If there is an actual live valuation that we have to do, we have to use a lot of thought into it. But one of the things that I have done is the revenue projections by the company has been taken at whatever they are. However, the salaries which are at management submitted only 44% are as direct salary. I have considered 49.4%. That is an additional 5% over the management submission as the direct salary. So this is one scenario that I have used. Scenario number 2, the salary percentage has remained at 44%, but the revenue growth rates are considered lower by 10%. Whatever the management submission has been done, I have considered a revenue lower by 10%. So if management has submitted 70% as revenue, I have considered 60.8% as the revenue. So this has to be done in the assumptions sheet or assumption wherever it is linked to the financial model. But the only thing is it has to be neatly linked. I have just copy pasted the linked thing to multiple, two more times to include both. And ultimately, you should have a setup like this. The live scenario in the initial, before you choose the choose formula, before you use the choose formula, it should continue to be linked to the main sheet, and that you can name it as live scenario. Then you have the management submission scenario, which is what has been provided in the projections. Then you have your own 2 scenarios. So ensure to name it like this. You should use the word scenario 1 or like that scenario 2. It is very important you use the word scenario 1, scenario 2 like that. Okay, you can before putting whatever if you want, you can use whatever, but after you put your input like lower salary, constant salary, ensure you use the word scenario 2 like that. Okay. And then when you come to the live study, before you do that, you have to do one more thing. You should input the live case. What is the number? Like, for example, if you use 1, then scenario 1 will come and all the cash flows will change. So direct salary will come at a higher rate. If I use scenario 2 over here, then the higher revenue number, the lower revenue number is considered 10% reduction in revenue. And if I use 3, the live case scenario will come into picture, which is the management submission. Just type this live case and then you can just use this. You can use this as an input. And when you use the choose formula and just a moment. Use the choose formula, link up everything, link up 3, and you link up 70.8%, which is scenario number 1, and then scenario number 2, and use scenario number 3. Link up everything. And if you use the choose here as 2, automatically the second one will get chosen. And when you use the 3, the third one will get chosen. It's a very simple and Excel is very intuitive this way. It's been built very well, but ensure the order of the formula that you use is this should be 1, this should be 2, and this should be 3. Only then the order will be maintained in the right way in the formula when you use. So as you can see, I have used H56 first, which is the first scenario, H84 second, which is the second scenario, and H112 third, which is the third scenario. So when I click on 3 here, the third linkage will turn up over there, right? So this is how the live scenario is built.
I must admit, and then this whole episode might have taken a lot of time, because normally you wouldn't have done scenario analysis for. So building a case for us and doing this link up, I can imagine how much efforts you would have taken. I acknowledge it. We are really, happy that you have undergone so much of, efforts.
Yeah, thank you, ma'am. I use scenario analysis in very rare circumstances when I totally disagree with the financial model that the company would have provided. Now, what we have to do is whenever the scenario changes, your valuation changes. So let me go over here and type in, just note down the number that we have, right? So currently we have 204 crore as valuation. So when I go over here and I change up the scenario to, let us say, scenario number 1, the value changes. It becomes 165 crores now because there is a dip in that or increase in that direct cost from 44% to 49%. So that has an impact of about 30 crores. Now what you should do is whenever you change the scenarios, these numbers change. It does not remain there. So if you have finalized your valuation model, there is nothing else to be done. All the rates, everything has been done and the valuation model is frozen. That is when you take up scenario analysis and you need to copy paste as values over down here below, or you can put it anywhere else. Scenario 1, this is the valuation you got. As you can see, none of these numbers are linked. They are all hard coded because once I use scenario 1, I just copy it and I paste it over here. Okay. And when the scenario 2 also, when I do, I copy the numbers that come in the calculator and paste it over here. And then finally, we come to the base case scenario, which is the management submission. So once we do this, based on the level of our disagreement, we can use various weights. So 75% in base case scenario, that is the management submission. Scenario 1, 12.5, scenario 2, 12.5. And you can have a weighted average valuation. These weights have to be determined based on the ranking that you're giving for each submission or each different type of cash flow. And the ranking is based on the reality and the probability of it occurring. Then weighted average valuation will be arrived at, and then you will have the equity valuation. So this is one way of doing a scenario analysis. So any questions on scenario analysis, just populate it in the chat box. We will look into it. And I will, there are some online videos also on how to build scenario analysis charts for valuation. There is another particular document that I'll be sharing, some useful links. So in that useful links, you will get these YouTube linkages to do scenario analysis and sensitivity analysis.
Your voice is breaking,
thing that
Anjan.
I definitely do in my practice is okay.
Is it for me, or is his voice breaking for others also?
For us also.
Okay.
But now I think it should be fine.
Now it is fine, right? All right. So one thing I definitely do follow in my practice is to carry out a sensitivity analysis of the various inputs that have gone in my valuation model. Like for example, size premium sometimes can be highly sensitive. So I use a size premium sensitivity analysis. If the size premium is up by 1%, what is the valuation that we get? Down by 1%, what is the valuation we get? CSRP, if it is changed by 0.5%, how much is the change in valuation we get? And what is the otherwise? Beta, if it changes by 0.1, what is the impact? Then equity risk premium, if it changes by a few percentage points. And finally, the long-term growth rate that has been adopted, if it changes by a few percentage points, what is the impact? There is some formula error here. Please do excuse that. When I share the financial model, it will reflect the correct one. But effectively, this is something that I use. And Shilpa ma'am had requested that we please do some sort of a graphical representation, change in graph and all. Many people use that. I'm pretty sure you use that also. I don't use graphical representations and all. But either ways, for the benefit of everyone, I've used something called as a tornado graph here. The tornado graph represents the same numbers that are drawn from here, no? Which has more impact. Like for example, size premium change in a percentage point here and there has a close to 10% impact on valuation. A beta of 0.1 change has about 7.5% impact on valuation. Equity risk premium changes have about 5 to 5.5%. CSRP has between up to 4 to 5% change. And then long-term growth rate, since there is an error in the formula, the tornado graph is also not shown. But yeah, you can put out a graph like this. Some of very good valuation reports I've seen have actually disclosed this particular tornado graph in the report. I am yet to do that. That is actually a very good representation of the various sensitivities involved. And it also shows exactly the kind of risk that we are in, and we are admitting that, see, even a point percentage here and there has so much impact on valuation. So we admit that this is probably one of the inherent risks a valuer faces in valuation. Now, how to do this sensitivity analysis? It's quite simple. Again, Excel has a easy methodology. Now, for example, let us say we want to do sensitivity analysis on small company premium. What you need to do is, before you go there, you need to just build up a small table like this. Change 0%, positive 1%, negative 1%. Don't fill any of this except valuation number. Valuation number, you link it to the valuation calculator. Now, next what we have to do is go to small company premium. We have considered 7.4% as small company premium. You link that 0% over there in the valuation calculator. So this is our valuation calculator where cost of equity has arrived at. Link that 0% here, 7.34% plus 0%. Your calculator will not change. It will continue to be 0%. Then all you need to do is you need to select this table. It'll all be 0, 0, 0 except valuation and change percentage. Share price, if you want, you can link share price also. Select all of this, go to data and go to what if analysis. go to what if analysis, go to data table, and in the column input, just select the whole table, and you will get these numbers will be auto populated. Again, I will not take you through the whole thing. I will link you a video where you can do this, but this is essentially how it is done. Now, I wouldn't suggest applying some sort of a weighted average on sensitivity analysis. It is only for our understanding of how sensitive various inputs are in our computational model. Otherwise, we should not, it's not good science to use various weighted averages on various sensitivity analysis. So
the
I think with
point
that,
why the sensitivity analysis is being discussed, or I have requested Anjan to raise this, is we have to understand that any statutory authority could question us on any of the assumptions. Then just in case we have the sensitivity analysis ready, we can highlight that we have done enough research on the implication of the assumptions what we have considered, and then the highly sensitive 1 or 2 or rather 3 or 4 assumptions have been worked out on the basis of research. Just with this analysis, I'm sure anyone statutory authority we can impress upon that, still there could be debate, still we could be grilled, but on the face of it, at a glance of it, don't you think that Anjan has done enough research just by this, tornado graph? Don't you think so, friends? That is why this, concept I want to introduce to everyone. We may not do it the very next assignment, but please keep this thought with you and try to, I feel this kind of analysis will elevate the value of the valuers in total. That is why this point. Carry on, Anjan.
Yeah, actually, that's it actually. And yes, ma'am, it's important that we do very good disclosures in the report, so that we will be conveying to anyone who reads the report that lot of research has gone in, and our report should be built in such a way that no one should actually come back to us for any queries. Or even if they come back, we should be able to tell them, please refer page number 73 or 74 of our report, and you will get the answer. So that, I think, that is the a model valuation report that I think we should all strive for. In fact, in our taxation field, when we do international taxation studies, we build a TP memo. And the gold standard of a TP memo is whenever there is a DRP hearing or anything, the income tax commissioners or any of the judicial members should never come back to us. The TP memo should be good enough for them to understand all the assumptions. And if they disagree with something, they can send a notice, but otherwise, all answers should be received in a single document. Right. So now I'll go to chat box. Before chat box, I'll ask Kusum ma'am, because she has raised her hand from quite some time. I hope her arm is not paining. So please.
Anjan, from your end, the discussion is complete, is it?
Yes, it's done.
Yeah. Thank you so much, Anjan, for keeping in mind, that I have a query. Actually, earlier in the session, we were discussing about the fact that, promoters actually bring in money not by way of equity because they want to kind of, save on the stamp duty, and they kind of bring it as loans and advances.
Right.
And you also mentioned that for all your valuation purposes, you will not really treat that as a debt, but rather you would treat that as equity. So my understanding to that extent is correct, right? But tell me, how do they really unlock the value? Because in terms of the agreement with the promoters, the only cash outflow, because it is in the nature of a loan, the only cash outflow for the company will be, the loan that.
So let me just clarify once here, Kusum ma'am. It's only for weighted average cost of capital purpose. I don't consider it as component of debt only for weighted average cost of capital, not for anything else. Like, for example, I have to still reduce it from enterprise value.
Yeah. Okay, so in the enterprise value, you'll definitely you'll reduce that.
That is there only for WACC. The ratio when I take, I don't want the ratio to be distorted by the promoter contributions. So that is the reasoning only.
Sure. Thank you so much for this clarification. Maybe I did not pay attention. Thanks so much.
Yeah, thank you.
Anjan, is it possible for you to share this Excel on the Zoom chat?
Zoom chat, okay. I will
Because
put it in the
friends,
group only. I think.
no, actually, Anjan, I have a point there. See,
Ah.
all your hard efforts will mean to the person who, it has to go along with an explanation. Or
Right.
else the person, it will lose the connect.
Understood.
The
Okay, I
case study
will.
has to be there, plus
Yeah.
this Excel, and to whoever are interested, they have come for the follow-up session. They have understood why you have used certain pattern. Because if I see the Excel without Anjan's supporting discussion, it may have a little, not a great value to anyone. And I don't want this to be some, just on BVM members chat wherein, it's of just a piece available there. I don't want that to happen. I really, have great value and high regards for the value and efforts you have put in. And it should reach only to the hands which have really attended this session. I don't think others have a different view.
Yeah, I understand your point. I will post it.
Because it comes with a lot of inputs, right? One number there is not just a number.
Correct.
Which you have, taken pains to explain to us, taking a separate session today, early in the morning.
Yeah. Okay, so what is happening is I tried posted it. It is coming as disk IO
You
error.
have to close the file and then if the
okay.
file is not, if the file is open, it can't be shared on Zoom chat.
Okay, just a moment then.
Friends, now the session is open for points, questions. Okay. So anyone has any points? Anjan, you are available there for 5-10 minutes more?
Yes, I'm there. So I think it will come now. Yeah, it got uploaded. So as I had told you, there is one small error in that growth rate formula. That in fact, you can use that as an opportunity and you can try out that formula by yourself. Let me also post.
Growth rate, what is the point, Anjan? Maybe I missed it.
Sensitivity analysis. There is an error in my sensitivity analysis only with relation to the long-term growth rate. So you can use that for, you can also try it out once to sort out that error. It will help you to understand. Let me also upload the useful links.
Useful links, I have no problem, even if you share it, because that doesn't come with a background, right? That is general. So
no,
it's up to you.
It is especially helpful only with regard to this model. But yeah, I have put in the useful links also. Rajeshwar Rao sir, please, you may.
Good morning. To add to Anjan's discussions on this sensitivity analysis, few people may not be comfortable in using too many Excel formulas. Generally, what I'll do, I'll keep version 1, version 2, version 3, version 4, giving this kind of sensitivity analysis to understand how it is changing. So just add to that, because some senior citizens may not be comfortable using this kind of too many formulas. That's it. Thank you.
And one more thing, one of the speakers where I attended scenario analysis had done some drop down, there was some cell wherein he used to drop down and automatically, I actually was a participant. I did that time, but now I forgot. So just in case I remember it, I'll share it.
It can also be done. So instead of drop down method, I used that 1, 2, 3 scenario method.
Drop down method was just some option of Excel, which I'm not able to recollect.
It is there. It is definitely there. I need to research. I have used it earlier in building financial models, but not for building valuation models.
Yeah, basically it is for financial modeling. Correct.
Correct. Yeah. So I will just answer some. Can I? Okay, Harish sir, I think how to deal long-term advances, management parking, surplus cash in long-term advances, surplus cash in long-term advances. So Harish sir, I'm assuming that it is some sort of a loan from director to keep in cash, or surplus cash in long-term advance. Harish sir, please, can you provide a better understanding?
When the projections is done, a lot of cash will be generating in the financial statements. That they're showing as long-term advances.
Oh, okay. So we need to understand whether it is critical for the operations of the company. Like, for example, to achieve a projected revenue of, let us say, 50 crore, you need to have some security deposit of, let us say, 5 crore. It might be either a contractual requirement or it might be a statutory requirement. That time we need to show it as a cash outflow in the free cash flow, adjustment to long-term assets. But if it is just to manage investments and to get money out of it, we should not consider it anywhere. I mean, it can be part of cash and cash equivalents. It can lie there.
Okay, thank you.
Alok Kaushik, could this base be used in near future to manipulate the value higher for? So, Mr. Alok Kaushik, I'll need the context of it. I forgot at what time you posted this message. I don't know what we were discussing at that time. So you may unmute yourself and speak on that matter. Otherwise, I would have gone ahead, then you can unmute yourself later. The valuation is for a specific purpose. Hence, DLOM may not be required if they already find a buyer. So this is what I had done. I had told you that between promoters, there was a specific purpose and they exchanged the shares so that they can maintain a certain cap table. And I did not use a DLOM there because I found there was no merit to be used there. But yeah, generally DLOM is required. Thank you, everyone. Yeah, one more follow-on session for sensitivity and scenario. I think we will find much more professionals who are much more competent and professional in scenario analysis and sensitivity analysis. If we can get them on board and have a dimensional view on all of this, that would be a good learning. Do you paste these analysis charts in your report in addition to normal? Yeah, so sensitivity analysis is something that I have recently started to put in the report. It's I have not been doing it before, but I put it these days just to show the extent of risk that is involved and sort of put myself away from these risks, especially something like ERP. Enterprise equity risk premium, there are multiple values available in the market. And if I use my computed value, what I'm getting, what happens if I use different values, it covers my risk basically. So most of these things I include, except micro level calculations I do not include. Otherwise, most of the things I include in the valuation.
Do you also include balance sheet projections, PL projections, cash flow projections in your main valuation report, which is signed?
Yeah, the projections I definitely put.
Even balance sheet projections?
Yes.
Small schedules also projections?
No, only the face of the projection and face of balance sheet and P&L projections I put.
Not the notes as such?
No, not the notes.
Notes or schedules. Just the main balance sheet, main P&L, main cash flow.
Yes.
So what if the client objects to it, considering the confidentiality?
Report itself is confidential, no? So first of all, in the report only I'm telling that they themselves should not share it with anyone. If they share it, I will file a case on it.
Actually, Anjan, the executive summary is given in many of the valuation reports. So any of the statutory filing purposes, actually that is supposed to be used, not the full report. This is my personal opinion. I don't know how others are doing it.
Right. So both in my letter of engagement and in my report, I have told that it should not be shared and it should only be used by the management, right? So if they share, then if they bring up that objection, I tell, so do you intend to go against my confidentiality requirement in the first
And then
place?
if I'm the company secretary of that company, when I'm filing MGT 14,
only
so
the
I'm not supposed to give I'm not supposed to give your full report, right?
Yeah, I don't know.
You have to specifically update the company secretary, Anjan, because valuers, we know we put something, but whether the company secretary is reading your thing. So I advise all the valuers, if you have same view like Anjan, just alert the company secretary that only executive summary should be used and not the full report, if that is your intention.
That's actually correct. That's a good learning. So
Actually, the format of my report flows in such a way that each and every part become linked to each other. So in that case, the whole valuation report will be uploaded with MGT 14. Otherwise, the valuation will remain like only one page that this is the value of the company. That's it. And that is fine or not, or the calculation has to be part of it.
Actually, I'll just give a small thing on this. There is, ICAI FAQ or somewhere where it says that executive summary is required. Executive summary, maybe Anjan can just highlight, what he does.
So
basically, it is the normal work valuation methodology we have chosen, the important dates and the value.
Correct.
Anjan can tell what else.
So in the executive summary, that's all I usually put. I usually put the equity value and the value per share that is disclosed, and of course the methodology of arriving at it, the various statutes and the thought process that has gone behind it. But no other numbers are usually put in the executive summary.
It is something like 2-page thing or 1.5 page thing. In my case, sorry, others could have a different view.
Okay, fine, thanks.
When I download, friends, Sheetal's point is good. And in fact, when I was doing research, I wanted to know how other, big names, valuation report. And I was not able to get the detailed valuation report in many of the cases. In many of the cases, public information was restricted. I could only access to the 2-page executive summary. That's why I thought of sharing this to all of you. Friends, we have come to a close. Okay. Thanks all for your, attending this follow-up session. Bangalore Valuers Association is blessed to have members like Anjan Babu who are putting so much efforts. His efforts are visible in the big Excel model, which he has, and he would have agreed with some NDA with his clients. So I'm sure he has taken pains to create a model for us, do all those calculations. And I always have, complicated expectations from him, like scenario analysis and sensitivity analysis, which will take a lot of his time, as a speaker to help us. And he will have to go through a lot and check in detail and research in detail. So his efforts are visible while answering our queries. His interest to listen to the different thoughts. I really am, I feel I should also have that humility what he has. Thanks a lot, Anjan. We are, happy to listen to you on, weekday morning session. Thanks a lot. I request everyone to put your reactions, the option, you have this option reactions, just as a token of, appreciation of all the efforts Anjan has done. Down here, we have options of reactions. So please put your reactions now so that, Anjan knows what we are feeling for him.
Yeah, thank you, everyone. I'm quite honestly overwhelmed because this actually is not much. We can do a lot more as a community of valuers, and we have a long way to go in comparison to the Western valuers and all of that. So let us all hope to improve our valuation standards and all of that, because I myself learned a lot of things, not just during my preparation time, but also during the panel discussions. Especially in this particular session, I learned quite a bit from Ganesh sir. I would actually, there are a lot of experienced professionals in our association who actually do not come forward and speak. One case in point, sir, being Ganesh sir. In fact, in the group, I have seen him answer many of the things in a very high professional way, which I feel I have a lot to learn and study from him. So, and Rajeshwar Rao sir also, I've seen a lot of.
And actually, Anjan Babu has kindly consented to lead the Bangalore Valuers Association Research Committee. On this context, he could be approaching few of you, okay, to be a member of it. Just making an announcement so that if you're really keen and, if you're really having that background and expertise, yes, you can approach me or Anjan, and we'll consider it within the committee and then take it forward. Anjan, you have any other point, or can we wind up the session?
We can wind up.
Mr. Sabu. Okay, Mr. Sabu, you can unmute. This is the last we'll be taking. You are on mute, Mr. Sabu.
Sorry, it was by mistake. No questions.
Yeah. Okay, friends. Have a very happy week. Bye.
Bye. Bye.
Bye for now.
Thank you. Bye.
Thank you very much. Bye-bye.
Thank you so much.